All right, welcome back everyone to the channel, the Millennial Messiah, and we are continuing reading the Lords of Easy Money, and we're just gonna get back right into it. So let us continue. Uh, None of this was easy for Honig. All of his life, he had been taught a Christian doctrine that emphasized non-violence and loving one's neighbor. He had no illusions about what was going on. You're trying to kill people. The whole purpose of the program here is to kill as many of them as you can, he said. He knew that if his team made a mistake, the consequences could be catastrophic. Honig dealt with these thoughts by shutting them out. He and his team took in all the data that they could, did the math as quickly and efficiently as possible, checked their work, and gave the order to fire. I just did the calculations, sent the signal, put it out of my mind. As far as he knew, the team never made a mistake that killed U.S. soldiers or civilians. After about 7 months near the front lines, Honig was transferred to a larger camp, where he joined a team of specialists who analyzed artillery accidents. He studied how bad data, bad decisions, or miscommunication could lead to catastrophe. Mistakes could be made quickly, in ways that a committee of 3 soldiers didn't realize at the time. One wrong assumption, one bad piece of information about air pressure, or one misspoken command could set off a chain reaction. Honig was spared uh, close quarters com- Honig was sparred close quarters combat, but he saw up close how chaotic and senseless war could be. A group of his friends from the artillery unit were shipping home when, on the way to an airbase, their truck hit a landmine and everyone on board was killed. Honig had known all of them well, and it seemed cruel that they should die with just 2 days left on their tour. He, on the other hand, made it home safely. When he got back home to Fort Madison in 1970, Honig faced the same challenge as other soldiers who had served in Vietnam. They had to make sense out of the terrible things they had seen and done overseas, and they had to do it at the very moment when Americans were losing faith in their government. A lot of soldiers were protesting, and Honig understood why. The war blew a permanent hole in the foundation of trust that Americans had in the democratic institutions that governed them. In 1971, the New York Times, the Washington Post, and a series of regional newspapers published a secret government report known as the Pentagon Papers, which showed that America's leaders had lied to the public for years about the war in Vietnam. Just 2 years later, President Nixon was caught up in a criminal conspiracy to bug his opponent's campaign headquarters at the Watergate Hotel. This was a time when a younger person might lose faith in American institutions, and many of them did. Honig turned to his father for advice. Leo Honig had fought his own war in the 1940s and managed to make a good life afterward. His advice to his son was clear and simple: move forward. It helped that Honig had a new life to move toward. When Honig and McKeon had talked during the quiet moments in Vietnam, Honig had talked a lot about the fiancée who was waiting for him at home. Her name was Cynthia Stegman, a Kansas City girl whom Honig started dating while he was going to college in Kansas. They'd met on a blind date. It didn't start out great. Cynthia considered herself a creative type who loved art. When she asked Tom what he was into, he said his passion was mathematics and economics. They went to see The Godfather and then got a drink at a lounge in downtown Kansas City. The lounge was dim, and while trying to take Cynthia to the dance floor, Honig walked straight into a wall. He bounced back from that and acutely laughed about it to himself. Didn't try to recover with a lot of bravado or try to impress me that he knew it was there or anything, Cynthia said. And I thought, this guy is terrific because he can laugh at himself. Tom and Cynthia got married after he returned from combat. Tom had returned in March, and by June he had enrolled at Iowa State University, where he planned to earn a PhD in economics. He would move forward. When Tom Honig studied economics at Iowa State, he studied it in a way that seemed quite strange in later years. By the 1990s, the field of economics would transform into something that seemed like the science of how to get rich quick. Modern economists developed theories that justified the actions of large corporations and banks, paving the way for international trade deals. New financial trading in exotic derivatives, and a relentless push towards maximizing profit for people who own stock. But in the early 1970s, Honig applied himself to a different kind of economics. This economics studied how America's democratic government could coexist with free markets. Honig studied the ways that capitalism, democracy, and regulation might be mutually supportive. His master's thesis, for example, was an in-depth study of the income tax in the state of Iowa. He began his paper by pointing out that the obligations of state governments had expanded dramatically since World War II. States had once been confined to passing and enforcing laws, but now they were committed to a growing range of public services, like operating highways and providing welfare benefits. This expansion of the regulatory state was already stoking anger in American politics, but Honig bypassed that controversy in his thesis. He didn't criticize the regulatory state, but tried to figure out how economics might help it function. The size of the regulatory state was the result of accumulated choices made by American citizens. If that was the case, then it ought to do at least work well. He examined the tricky issue of how the state could meet its budget while collecting taxes that rose and fell every year. Honig was more agitated by the idea that a state might miss its budget targets because it failed to analyze the right numbers. His thesis employed exclamation points on this matter. A 5% decline in personal income would imply a fall in revenue, or perhaps 2 or 3%, just at a time when larger state expenditures had already been authorized. Honig argued that the state should hire serious number crunchers and economists to help the project as accurately as possible. What future sales and income taxes might be. After 155 pages of charts, tables, and citations, his ultimate conclusion was unsatisfying in its humility. Setting budgets would always be maddeningly unpredictable and uncertain. The best that can be done is to look at the available data and make the best possible judgment, he wrote. For his PhD dissertation, Honig turned his attention to the banking system. By the late 1960s, banks were merging with one another at a fast pace. If this continued, Honig worried, it might create a banking system that was dominated by very large institutions. I could almost see the beginning of the end of the community bank, he later recalled. Honig studied this issue in a narrow way, similar to how he studied state tax issues. He wrote a deeply technical report that aimed to help federal regulators decide if they should approve or reject a given bank merger. He did this by examining the market for consumer loans, the type of loan people use to buy cars or send their kids to school. Honig noted that when there wasn't a lot of compensation between banks, they tended to charge people more money to borrow. By charging higher interest rates and pay them less money to save by offering lower interest rates. Honig compiled loan data from all 50 states and parsed it. He found evidence that the market for consumer loans was segmented, meaning that banks didn't have to compete directly with other institutions like credit unions for loan business. This meant that regulators should only consider the impact that a bank merger had on the concentration of ownership among banks, rather than considering what impact it might have on the concentration of all lending in a given area. This wasn't the kind of finding that generated big headlines, but it could help a lot of people and keep banking competitive. Decades later, these papers would illuminate how Honig thought about banking and finance. He didn't study how to boost profit margins or make a market more efficient. Instead, he studied the structure of banking institutions and thought about how it impacted society. This reflected a viewpoint that was widespread in an era when Honig grew up. It held that bankers were motivated to make money, but that it was up to the government to make sure that the banks served a broader purpose, feeding economic growth and providing a healthy circulatory system for money. The structures of banks mattered a lot in this view. It might not have been surprising, considering his studies, that when Honig graduated with a PhD, he pursued a job not in banking, but in banking policy. Honig heard that the Kansas City Federal Reserve was looking for a research economist in the Department of Bank Supervision. Honig wrote a letter to the Fed laying out his qualifications for the job. In 1973, he was hired. Tom and Cynthia moved to Kansas City. For Cynthia, it was coming back home. For Tom, it was a move to the big city. Each morning he went downtown to the Federal Reserve Building and joined a team of economists analyzing the conduct and operations of banks throughout the Kansas City Fed's district, which included Colorado, Kansas, Nebraska, Oklahoma, Wyoming, and portions of Missouri and New Mexico. This is where Honig began his long education in the inner workings of the institution that would define his entire career in public life. This is where he started to see how powerful the Federal Reserve really was and how it actually worked. There is nothing in the U.S. Constitution that demands or even specifically authorizes the creation of a central bank, but it turned out to be impossible for a modern nation to survive without a central bank, and the United States proved it. America tried to get by for about a century without establishing a government run bank that controlled the currency. Between 1776 and 1912, the United States twice created and then destroyed a central bank. The country resisted having a central bank because it concentrates so much power into so few hands. This concentrated power would undermine the entire American project, which was, ideally, to put control of the government into the hands of average citizens. When Andrew Jackson revoked the charter of the Second U.S. National Bank in 1836, he called it dangerous to the liberties of the people. It's not hard to understand why. Imagine if one bank had dominion over the entire financial system and the leaders of that bank could decide who got loans and who didn't. Those bank leaders would be the most powerful people in the country. Such a scenario is, by any measure, anti-American. The early American banking system was decentralized, and it was a disaster. The reason things can't work without a central bank is that every modern nation needs a reliable form of currency. Currency is the medium of exchange that holds value and transfers value from one person to another. Without currency, people would still be trading corn for tobacco and trying to figure out the exchange rate. Without a central bank to issue a national currency, creating money becomes a cottage industry. In the mid-1800s, the United States had thousands of different currencies floating around. One count put it at 8,370 currencies. This was called the free banking era, and it was lunacy. Any bank could issue money and the currency was backed by the bank itself. So if the bank went bust, the money went bust with it. Every person had to make a judgment about the health of a given bank to figure out if they wanted to use its currency. A person could get money from a bank in Illinois and then travel to Oregon only to argue with a clerk at a hotel whether the Illinois currency was any good. Congress passed a law after the Civil War that chartered a series of national banks around the country, which issued a more uniform currency. But even if the currency problem got ironed out, there was a second reason that a central bank was necessary. The American banking system was still hyper-fragile and subject to regular panics and failures. Major banks panics broke out one after the next in 1893, 1895, and 1907. Bank runs were inevitable in panics because there wasn't an all-powerful central bank that could print money and act as a lender of last resort, providing loans when every bank needed money at the same time. Without a lender of last resort, the banks were left to bail out one another, using whatever reserves they happened to have on hand, or to fail. The Fed was given power to print money and loan it out freely to otherwise sound banks during a panic, which had the effect of stopping panics in the first place because borrowers knew the Fed was there. The Fed dispersed its emergency loans through a program called the discount window. Finally, on top of the bank panics, there was a third problem. There was no central bank to manage the overall supply of money itself. Demand for currency went up and down in unpredictable ways but the money supply couldn't change along with it. Every autumn, for example, farmers withdrew from their local banks to hire workers to harvest their fields. This drew down the limited cash reserves at banks in the Midwest, which made them scared that they might not have enough cash on hand to meet their obligations. So, when those rural banks ran low on cash, they turned to the bigger regional banks in cities like Chicago to get cash. Those regional banks then turned to the New York banks, and the New York banks turned to the big banks in Europe. This could turn into a panic and be truly ruinous for everyone. The bank panic of 1873 led to a depression that lasted about 6 years. This helps explain why the push for major reform to form a central bank didn't come from bankers. It came from the hell-raising populist and free silver movements formed by angry farmers in the middle of the country who needed loans to survive. The politics of money was suddenly a riotous public issue. William Jennings Bryan was playing to the crowd when he did his cross of gold routine. People were already angry about monetary policy. The popular effort to form a central bank gathered strength during the early 1900s, but the movement didn't become a realistic political possibility until the Wall Street bankers decided to get behind it. To the everlasting joy of every conspiracy theorist in America, a group of ultra-powerful bankers got together and held a secret meeting in 1910 in which they created the blueprint for an American central bank. The bankers met at a luxury resort called Jekyll Island, making it easy for the future filmmakers and authors to talk about the Fed as the creature from Jekyll Island, as if it were a secret plot that the bankers foisted on America. But this isn't the case, as William Grader made clear in his seminal History of the Fed, Secrets of the Temple. The bankers did push their plan in the U.S. Senate, but they were riding a wave of public sentiment that had been building up for decades. A central bank was inevitable by that point in the United States, but the bankers at Jekyll Island did secure an important victory at their secret meeting. They made sure that the U.S. central bank would not usurp the power of the private banking system on Wall Street. This was very important. The populists had proposed all kinds of plans that would have democratized the process of controlling American money, even bypassing the big banks. One plan put forth in 1889 called for the U.S. Treasury to establish a network of grain elevators and warehouses around the nation that would be decentralized sub-treasuries, where farmers could deposit crops as collateral for loans. The bankers at Jekyll Island exterminated such wild notions. They put Wall Street at the center of the proposed Federal Reserve System. When the Fed increased or decreased the money supply, it would do so through the commercial banking system, letting the banks decide how the money would be distributed into the economy. The Jekyll Island plan was debated and modified in Congress and passed in 1913, creating the first enduring central bank in U.S. history. But the deeper, very angry American tension over having a central bank never went away. America needed a central bank, but it didn't want one that was too powerful. This tension was encoded into the Federal Reserve's DNA. The Federal Reserve was both a government agency and a private bank. It was controlled in Washington, D.C., but also decentralized. It was given total control over the money supply, but didn't replace the private banking system. It was insulated from voters, but broadly accountable to politicians. The tension was also encoded into the Fed's structure. It's why the Fed is a network of regional banks governed from an office in Washington, D.C. The 12 regional banks might be one of Congress's strangest creations, mixing public government with private enterprise. Each regional bank is owned by a group of private banks in the district. The private banks own the stock in the regional Fed, though they can't sell it. The private banks in each region are given seats on the regional Fed's board of directors, and the board selects the bank's president. This was designed to create a decentralized system with powerful regional banks that are accountable to both the community banks in their region and to the Fed's governing board in Washington. While the Fed was supposed to look like America, a federated nation of 12 regional banks, its governance became more centralized in Washington each time the Fed's charter was updated by Congress. The power of the Fed now rests largely with the bank's board of governors, of whom there are 7, nominated by the president and approved by Congress. The tension between the governors and the regional bank presidents is seen most acutely inside the Federal Open Market Committee. Because the governors have a majority of seats on the FOMC, they set the agenda, and the board's power only increases in times of emergency. When the Fed becomes the lender of last resort, the governors can take action without the approval of the full FOMC. This was the institution that hired Tom Honig in 1973. It is not surprising that life inside the central bank appealed to him. The Fed embodied his worldview. It was the result of a series of unhappy compromises, and it seemed like the best system America could create to tackle difficult problems. One of the Fed's important roles is to regulate the banking industry, to help ensure that banks' panics and bank failures don't destabilize the wider economy. Honig would spend nearly 2 decades in the supervisory department, meaning he was a bank regulator. He was well suited to do this work. As a kid, he'd helped his dad tally the family's store's inventory. As a soldier, he'd helped calculate the trajectory of artillery shells. At the Fed, Honig helped analyze the constant inflow of data about banks inside the Kansas City Fed's large district. This is how Honig got a front row seat to observe the biggest banking crisis since the Great Depression. Honig's job involved a lot of arguments with local bankers. The substance of the disputes usually centered on a topic of paramount importance, the value of assets. The bankers often thought that their assets were worth more than the bank examiners thought they were worth. The consequences of such disagreements were enormous. Honig and his team were trying to make sure that the banks weren't making dangerous loans or getting so overextended that they might fail. The assets in question were held as collateral at the banks. If a bank had more collateral, it could make more loans. But if the Fed ruled that its collateral was worth less than the bank said, then the bank needed to raise money to cover the value of its loans. In dire cases, the bank could be taken into receivership and essentially dissolved. If the arguments were heated, there was no doubt who held the power in the relationship. Fed examiners had access to the bank's records and employees. They could see what they were lending and to whom. Honig was fascinated by this work, and he knew it was essential to keeping the financial system stable. The job was also a challenge. It was surprisingly complicated to determine the health of a bank. That's why the arguments over asset values were so important. If a bank in Oklahoma loaned $1 million to an oil drilling company, the riskiness of that loan depended on the value of the assets the bank received as collateral. One common form of collateral was future revenue expected from oil wells, but that raised a lot of variables. If oil was going to be worth $20 a barrel on average over the term of the loan, then the collateral might be worth $1.5 million. In that case, the loan was super safe. But if oil prices fell to $10 a barrel, the collateral would only be worth $750,000. Now the loan was looking riskier. This is why bank examiners were entangled in arguments. The value of an asset is always open to debate. As the 1970s progressed, such arguments became more heated and eventually turned desperate. The reasons for this can be traced back to the Federal Reserve Bank itself. While Honig's team of examiners were trying to keep the banking system safe, they were being undermined by a different, far more powerful arm of the Fed, the FOMC. The policy board in Washington was doing things that fundamentally changed the behavior of the very banks that the Fed was supposed to be keeping healthy. During the late 1970s, the Federal Reserve encouraged the banks to extend riskier and riskier loans. The FOMC was keeping interest rates extraordinarily low, in part because there had been two recessions between 1970 and 1975. The Fed wanted to create jobs, encourage investment, and boost overall economic growth. So it kept rates low even as the ill effects of creating so much money became more apparent each year. The most obvious effects of this policy showed up in raising and rising prices for consumer goods like fuel, food, and electronics. In 1973, the rate of consumer price inflation was 3.6%, meaning that the cost of goods most people bought rose by 3.6% from one year to the next. By 1979, inflation had surged to 10.7% per year. The change was obvious to everyone. It showed up in prices at the grocery store and the gas station. It showed up in the payroll department of companies that needed to give big pay raises every year if employees were to keep up with the cost of living. But the Fed wasn't just inflating consumer prices, it was inflating asset prices as well. This was the form of inflation that was alarming to bank examiners like Honig. The value of farmland, a key asset for banks within the Kansas City Fed district, was rising steeply. So was the value of commercial real estate and the value of oil wells and drilling rigs. These assets were the collateral on banks' balance sheets, and their rising value encouraged more aggressive lending. Banks throughout the Midwest extended big loans to farmers based on the theory that the value of farmland would keep rising and support the value of the loan. The same thing happened in the oil business and real estate. Honig heard about short-term construction loans that were extended based on the theory that property values would rise so quickly that the loan could be refinanced as soon as the building was finished. This was pushing the banks to make riskier loans. High inflation and relatively low rates discouraged banks and investors from saving money because savings only earned small interest payments compared to the value it lost from inflation. The banks had to find something to do with their money that earned a good return. They were pushing out further on the yield curve. Honig and his team watched this happen, but there was very little that they could do about it. As asset prices rose, the bank could credibly argue that the loans were safe and the banks were stable. The examiners at the Fed could argue otherwise, but the bankers had the numbers on their side. In 1981, Honig was promoted to vice president of the Kansas City Fed Supervision Department, overseeing a team of about 50 bank examiners. He got the job just in time to learn his most important lesson about the role of the Fed in American economics. He got to see what happens when a long period of inflation comes to a sudden, unexpected stop. You have this enormous collapse, Honig said. Failure upon failure, loss upon loss, crisis upon crisis. All right, so we will leave off there. That was chapter 2, and we will pick up next time on chapter 3. So thank you for those of you who tuned in. If you haven't subscribed to the channel, please subscribe to the channel, because here on this channel, Millennial Messiah, we are going to be doing our best to gain more knowledge, because as we know that knowledge is intelligence, and God expects us to learn and increase our knowledge in all things. And learning about the Fed together through reading this book is very important, so we can learn how to better our own financial standings in this crazy world that we currently live in. So we will pick up on chapter 4 in the next video. Please hit the like button and subscribe, and I hope all of you have a good rest of your night. Thanks.